we've got the latest version of a uh, proof of concept that we put together for a global container trader. Um, and so start with kind of the impact. The proof of concept that we built around container forecasting, we estimate to generate between 120 and 600,000 increases in operating profit if they can transact based upon our forecast. And this is just 5 ports across their whole operation would be a bigger impact. Couple insights that with a model that only is tuned to macroeconomic factors, we have a pretty high prediction rate for the 20-foot, 40-foot, and 40 high cube containers across Newark, Savannah, Chicago, Norfolk, and Charleston. And for this specific customer, they're local traders, so they don't have a centralized forecasting system right now. And so that'd be part of the value prop, and also provide predictive factors to them. And I'll get into how we would do that. And then we also will be able to do this across uh, different markets and using different data types. All right. So how do we get going? Well, first off, we need to put together a data set like this, which is from the customer. It's their prices and containers. I think it's the last 6 years. Um, and once we have that information, we lay that up with some macroeconomic factor data, which is here. And you'll have seen this stuff before, but it's the typical macro stuff, inflation, CPI, household income, things like this. We pulled this data from an API that's hitting the Fed, um, and organize information, clean it, do the typical uh, quantitative and outlier analysis of the data set, and then we lay it up with the data provided by the customer, right? The containers. All right, cool. So let's take a look at the data. And these are the container plots. If we grabbed all the data from, I think it's about 80 macro factors, it's going to become an eye chart pretty quick, especially if you normalize. Uh, so looking at just the containers, this is what it looks like. So peak around COVID, post COVID, and then now it's coming down. All right. Um, okay, so now that we got the data, we want to do some basic correlation analysis. You can see this is over the last 10 years for all the macro factors. This is the correlation matrix. Red is correlated, blue is negatively correlated, and this is, you know, highly concentrated, right? So what we have to do is we have to take this set of 80, and looks like there's a bunch of dependent factors, and we need to reduce those down. We do that at first with principal component analysis over the same time window, right? So we can do it for a shorter time window if we want to, and for 10 principal components, and out pops the factors that are explaining this: household income, PPI, stuff like that. All right, and this is another visualization technique. All right, so this is a good start, but it's not the whole story. Now we need to figure out of that sample set which one of those factors is causal. And the way that we do that is we run a Granger causality analysis on all those factors that we talked about on the specific container markets that this customer trades. And this is an eye chart, but the way to look at it is red is causal. Anything not red is not causal. So one of the things that pops out of that is, okay, now we can grab the significant factors, the significant factor details for each one of the markets. And highlighted means it's causal, right? Great. So now going one step further, that identified all of the factors that are causal, but not the right size set, the ensemble of factors, the ones that aren't, related to each other. And we use a technique called VIF to do that. And out pops, let's say, the right size set for the Newark 22-foot container. Here's the factors. And those would be different for, let's say, the Savannah markets, right? As we'd expect. So now that we have the causal factors laid out, we can actually we can attempt to predict these container markets with the factors. And lo and behold, even using something simple as the linear regression model, we have a pretty tight fit. I mean, there's some big gaps over the last recent years, but with the dumbest model we could select, kind of not bad. And we did that at 1 month, 2 month, and 3 month horizons. Um, and one of the things that we get out of that is model coefficients, right? So we can say, all right, for the 1 month ahead Savannah container market, we think that the steel products, and sorry, Newark market, steel products, scrap metal, are kind of driving it, right? Okay, cool. And then also we can run something that's doing a seasonal forecasting model, right? So for just 3 months, so not long enough to see the seasonality, but now we actually can forecast out in the future from today what the price is going to be, and then correspondingly we can get the container price report relative to today. So we have the last price that we have, which is as of September 30th, and then we have prices in the future, October, November, December. If they're higher than the forecast, color code them green. If they're lower than the forecast is lower than the last price, we color code it red, right? And so this is basically the buy sell indicator for this. Um, One of the things that we've also been able to do, spend some time on, is building a more advanced machine learning model, right? So the first model that we showed was primarily a simple regression. And so one of the things that we've looked at doing is, okay, now how do we start bringing in some AI and ML techniques for the forecasting, and then feed those into the markets, given we have this causal set of factors. And you see the model's calculating now. I mean, pre-run before the demo, apologies. But what we're going to see is a significant performance improvement. Um, so whereas we saw R squared, which is a prediction level previously like zero point 0.7 or zero point 0.8, now we're looking at something very significant, and the lines are much tighter. As a reminder, previously with the simple linear regression model, we were looking at kind of a little bit off. Now, when we want to run the fancier models, machine learning AI models, you see a much better performance. And we can also use that to build out the seasonal forecast again as well, right? Um, and so now that'll have its own report, and we'll see that if the forecast is lower than the current, it's a sell. If the forecast is higher than the current, it's a buy. And we lay this information up. So that's I think that covers pretty quick analysis of the model. Oh, and the other thing I want to mention is that for some model types, there's not natural coefficients, but there's techniques that we can use in order to um, build models and then get the weights for the coefficient. So this is called a feature importance um, ranking. And this is interesting because even in a AIML model, we can then still lay up which factors are driving the forecast. Um, yeah, so this is still pretty rough, pretty early, but this is for the use case of being able to put together a buy sell forecast for a container trader, which is laid up here. So yeah, we got another client demo today. Fingers crossed. Yeah, if you're still listening, man, please share any feedback. Thanks, dude.